All right. Good morning, everybody. Hope you had a good weekend and that you're all doing well and staying healthy. Just a reminder, next week we have the final exam. I will email you the final exams this Friday around noon. You have 2 hours to do the exam. You can choose 2 hours of your choice to do your exam. Absolutely no collaboration with anybody else. You can use your laptop for computational purposes, but no surfing of the internet. You're welcome to, frankly, you won't find any benefits from surfing the internet because I take a lot of pleasure in making my exams very unique. So you won't get any advantage, but you're not allowed to anyway. So you will have I will email you the midterm this Friday at noon. You need to do your answers. There will be 2 questions. I have posted a sample final exam on Blackboard. It will be similar to that. You are required to there'll be 2 questions, both your answers in one Excel file that has to be named exactly the way it has been mentioned in the exam, exactly, all right? We have had a number of conversations about it because otherwise all kinds of errors creep in and we don't want to do that. You all are sufficiently sophisticated. You know, in the big data world, automation is essential to avoid human error. So you need to put them in one file named exactly the way I have described it. I've requested you to do. And your final exam needs to come back to me as a reply to my email, not a different email. Don't change the subject, nothing. Straight reply to my email, okay? Significant points will be deducted if you don't follow the instructions exactly. Also, remember, as I have talked to you before a number of times, when you're merging data sets, something like a VLOOKUP is essential. Because if you were doing SAS or Stata, you would have other options, but in Excel, it's the very convoluted VLOOKUP that we have to do. If you were to just copy and paste data sets next to each other, that is just wrong, and you will lose a significant amount of points, which so I'd strongly urge, hopefully at the result of this course and the fact that you are advanced graduate students at a top university, you know perfectly well that you cannot do that. So it would be a significant negative if you tried to do that. All right, so to reiterate, I'll email you the exam at noon this Friday. Please send your final exams back to me as an attachment in one Excel file named exactly the way I've said or told you to do, as an attachment in a reply email to me. All right. You need to follow, everybody needs to follow the instructions exactly, because even if one person does not follow, we cannot automate it. Everything will have to be done by hand, and that brings in all possibilities of human error, which we absolutely have to avoid. Given how much money you are paying for this course, it is absolutely critical that you get exactly the grade you deserve. And it's part of my job that I take very seriously, is to make sure all of you get exactly the grades you deserve. So you need to follow those instructions. Otherwise, even as I said, even one of you not following instructions is going to mess the whole automation part up. All right, you have until Tuesday, a week from today. So from Friday until the following Tuesday, you have pick any 2 hours to do your exam. It's a closed book, closed notes exam, but you can bring in 2 sheets of 2 sides of a letter size paper for your exam. And you will need to do it on your computer. You can use the computer for computational purposes, as you should, as you have to. But beyond that, when I ask you to download data and everything, please do so, but don't try surfing the internet for answers. Any questions before we move on to today's class? Okay. First, we're going to do foreign exchange. We're not going to spend a whole lot of time on foreign exchange. It's actually, much easier to teach foreign exchange to when you have a number of people like yourselves with strong international backgrounds. Because if I'm teaching, let's say, American undergraduates at the University of Maryland, many of whom have never left the country. So maybe many of whom have never had the opportunity to even use foreign exchange. So they're kind of, the foreign exchange markets are, they're not fully sure they comprehend until you have actually traded or earned in one currency and paid in another currency and so on, like you all are having to do. It just is so much easier to explain. So let's go to words. Chenlu, can you see the internet browser?
Yes, I can see the Google page.
Okay. All right. So please follow along with me. Go to log in, as you know how to do. You have the H640 SP20. Then go to get data, economics data. Keep going down where you see currency exchange rates, go to FRB, which is the Federal Reserve. Okay, now it asks me to submit this again, so which we will do. It's very annoying, but that's what it is. Foreign exchange rates, go to data. Hold on for just a second. All right, so let's choose our date range. Let's focus on, let's say, 200201 to the most recent data we have, 2019. What are the countries we want, which will be relative to. Now, one of the things about foreign exchange, it's always in terms of one currency in terms of another. So the way to think about it is, for instance, let's say the price of this bottle, if I say this price of this bottle is $1, it is $1 per unit of the bottle. So it's $1 per 1 unit of the bottle. So similarly, when we talk about the exchange rate, we always have to be very careful about, so the price of let's say an Aussie dollar is $1 US dollar per 1 Australian dollar. All right. So, but you can exchange rate, because it's one currency in terms of another, you can easily do the reciprocal. And so you have to be very careful what exactly you are measuring. As long as you're very careful, it doesn't matter, but you just have to be. All right. So we take Australia, China, India, Japan, Euro. Okay, let's take these exchange rates. Excel spreadsheet.
Excuse me, Professor?
Yes.
There are 2 euros. So which one, how do I know which one should I choose? There are 2 euro.
Where do you see 2 euros? There's 2 ECUs.
One you just choose, and
there's another one over there.
yeah.
All right, let's just pick both. I'm not, I don't specialize in foreign exchange, so my knowledge of this data set is not the way, not as strong as it is about equities or options. So, what I always talk about when we do big data work, if you ask me a question, which of these, my answer always is both. Right? It's similarly with methodologies. Anytime you ask a question, the answer is both. Let's figure it out, okay? So let's see which of these is makes more sense. One of the reasons I actually picked 2002 onwards is from January 1st, 2002, that the euro became widely traded. All right, I'm going to download it. Download FinEcon FX rates 2002 onwards. All right, let's put them in uh, okay. Mavis, can you see what the difference is between the two?
Yeah, it's home. It depends on which one is the home currency, which one is foreign currency.
Right. It's the one is the reciprocal of the other. So let's put everything in with the denominator being US dollars. And so we can delete column F. Okay. So the yen per US dollar is actually very interesting because it's kind of it just goes at a much higher than any of the others. The US dollars, as you can see, it has Australian dollars. It has varied a lot. The Indian rupee is well, it's just look. Actually, before I do, Shing, do you remember when you had sent me that email a while ago with these things kind of acting up? You see these blanks? If you were to try to plot this, Excel has this very annoying habit of treating blanks as zeros. Okay, so one of the things is, for instance, in SAS, it makes this clear difference between a missing and a zero. But so the only way to really deal with it is to delete all rows with blanks. All right, so let's say we wanted to get a sense of the Australian dollar and the euro, how that goes. So let's say we wanted to plot. All right, so let's see. So, you know, interestingly enough, now, what does it mean over here? Let's take a look at the Australian dollar first. Starting from beginning of 2002 until now, right around the beginning of 2002, one Australian, so this is how many Aussie dollars you get per US dollar. So over around here, you get about 2 Australian dollars per US dollar. Or flip side, each Australian dollar is about half 1 US dollar. This is around the time that my wife and I came back to the US from Australia. So a lot of our savings, investments, everything were in Australia. And we actually had to leave a lot of it back because we were getting absolutely horrible exchange rates for our Australian dollar. Since then, it has changed a lot. The one number is the interesting one, always to keep in mind with these currencies like the Australian dollar and the US dollar. One is that one number has no economic value, but it has a lot of a psychological value. You're basically saying, is the Australian dollar more expensive than the US dollar or not? Just around this area, as you can see, this is in 2010, the US dollar actually became less expensive than the Australian dollar. It went below 1. Otherwise, it's kind of, it went through a spike, then the Australian dollar regained some value and then went down, regained some value. I'm sorry, Australian dollar is above here, then it gained some value, lost some value, gained, lost, and went down. And then over here, it's gained value because it's below 1. Australian dollar is gained value. Remember, we're talking about the Australian dollar being reciprocal, and the flip side of this, the US dollar in terms of Australian dollar, is just the opposite. And over here again, the Australian dollar has lost value and so on. The euro, interestingly enough, when it started trading initially, it was actually more worth less than the US dollar, or rather speaking the other way around, the US dollar was worth, each US dollar was worth more than 1 euro around here. But since then, for pretty much the last 20 odd years, the euro has been more expensive than the US dollar. And that's what we're seeing here. Any questions? Some of the stuff that you can do with these kinds of example is actually, like, for instance, calculate volatilities. If, for instance, you are a foreign exchange trader, like my wife used to be, having a sense of what the volatilities are is very important. So you can do all kinds of standard deviations, take a mean and get summary statistics, do correlations, all of that stuff that we have talked about in this class in gory detail. You can take all kinds of summary statistics of these underlyings, just as like we would do with securities. Now, one thing that to keep in mind, there is a very active futures market in foreign exchange, which of course makes sense because, and which we will get to in just a minute. So I'm going to open up one more. This is an Excel file that is posted on Blackboard. Number 30. So here what I've done is just downloaded, all the data sets, and all the fields rather from words. And as you can see, column AP, the exchange rate for the euro in beginning of 1981, the euro is just a dream. It has come nowhere close to fruition. So naturally, these are empty. So these are the raw data that we talk about. And let's look at some data. So this is RMB per USD and Indian rupee per USD. The RMB per USD is the blue on the left axis, and the orange is the Indian rupee on the right axis. Now, if we just look at the Indian rupee, how it has steadily lost its value over the past 40 odd years. But one thing to keep in mind is with these exchange rates, I've taken two economies which used to be substantially government controlled, but are much more open markets now. You can see over here, when you see these straight lines, either flat or straight, or horizontal flat lines or vertical straight lines, those are indicative of government intervention. Otherwise, you don't really see those very straight lines in the absence of government control. So you can see over here, this area in the Indian economy, this is when India is going through this huge crisis in the late 80s and early 90s, when the government has substantially deregulated its foreign exchange flows and allowed it to substantially trade on open markets. Back when I left India, just around this time in 1988, this was, the Indian, you can see it was about, when I left India, the official rate was about 13 Indian rupees to $1 US. But that was the official rate. You could only purchase that amount of money from the central bank, from the Reserve Bank. If you wanted to get more money, what was essentially the market rate was easily 2-3 times that, because in India was a very closed socialist economy in the until the 1980s. But since then, it has floated significantly. As you can see, it's floated in fits and starts. But beyond, 1995 or so, you don't see those straight lines anymore. This is indicative of the fact that the Indian rupee has essentially been freely traded, but not fully freely traded. Governments always come in and say their own stuff. But it has been a market traded currency, which is why you don't see those straight lines, either vertical or horizontal, with the Indian rupee. If you look at the similar remember, the Indian rupee's numbers is on the right axis. Okay, so it started from about 13 to now it is what, 17. More recently, it's gone up to like 77. The Indian rupee has been steadily losing its value, which of course is great for Indian exports, not great for Indian imports, which is what there are these slides which I'll walk you through in just a minute, where you can see that one exchange currency becoming stronger doesn't necessarily mean it's better, because there are pros and cons. Okay, so that to keep in mind. For if the Chinese currency, if the RMB becomes weaker, it is better for Chinese exports to the US. But on the other hand, if you or your parents are earning in RMB and spending in US dollars for your education, it becomes more difficult. Okay, exports, imports. It's both sides. So you don't let stupid people fool you into thinking one side is better than the other. It's really not something that an economist should ever say. All right. Having said all that, on the left axis you have the number of RMB per US dollar, and you can see in the 1981 this number is about 1.5. That number, once again, like with the US dollar, it's not particularly meaningful at that point. China has not integrated with the world economy. Its exchange rate is fundamentally controlled by the government. And so, and as you can see with the Chinese economy, once again, being a much more socialist economy than the Indian economy is, there are many more of these straight lines. So these are situations, and you can see a straight line like this. This is where the government is forcing the currency rate to be at that level for a certain amount of time. When you see a drastic straight line like over here, this is when the government is devaluing the RMB during this period. Then you go down, then it's freely trading for a while, and again there is another flat period. And those kinds of flat periods can only happen if you have government control. Again, there is another control. But if you look at more recently, there has been a much, the Chinese government clearly intervenes in foreign exchange markets much more than the US government or the Indian government or the European Union or the Japanese government or the British government do. But you can still see that it has been more recently much more floated, as you can observe. So it's fascinating to see how foreign exchange markets have changed over the years. So this Australian dollar per US dollar, which I showed you earlier between 2002 and more recently, but if you go starting from 81 to last year, you can see that it has changed a lot. It's been quite a volatile currency. And also to keep in mind, until about this period to the left of this, the Aussie dollar was not exactly floated either. It was controlled, but as you can see, you can still don't see those straight lines either way. Similarly, you can look at if you wanted to compare to the Indian rupee versus the per US dollar and the Japanese yen versus US dollar, you have them on two different axes. And as you can see, the orange right is the Indian rupee, the gray line is the Japanese yen. The Japanese yen has grown. The trend is for the Japanese yen to strengthen versus the US dollar, whereas the trend is for the Indian rupee to weaken against the US dollar. Back in this area when the Japanese yen was significantly, each Japanese yen was significantly lower than, sorry, you had to pay significantly lower than 100 yen to buy a US dollar. It was a very different world than it is now. Let me just make sure we're getting it right. The Japanese yen per USD is on the right axis, and it has the Japanese yen has strengthened significantly. It used to be, if you might remember Lee Iacocca, the former chairman of Chrysler, and in the late 80s and early 1990s, when Japanese imports, especially of cars, were beginning to really explode in the US, there was a lot of criticism within the US automotive industry about the fact that the Japanese yen was being kept artificially low by the Japanese government in order to encourage its exports of automobiles imported into the US. So as you can see over here, the Japanese yen was significantly less than 100, and since then it has strengthened a lot. It used to be the case around here that Lee Iacocca used to say, "I am 100 yen person." And you can see it's changed significantly. The Japanese yen has strengthened significantly since that. Any questions? Okay, foreign exchange. I'm not going to spend too much time on it. So this is the overall big picture that we talked about. Please go through it at your own time. Essentially, it is the supply and demand determination of foreign exchange rates. Very straightforward. And the always to keep in mind is if for instance, US exports to Australia goes up, how that affects the foreign exchange determination. All right. And please answer these questions at your thing. Now, I'm going to walk you through this particular example of that was a litigation I was involved in. Sadia, a leading Brazilian food and beverages company, founded in 1994. It's now called a BRF brand. It's traded on the Bovespa, which is the Brazilian equities market. And it had an ADR, which was traded on the New York Stock Exchange as SDA. The allegations were that between April 30th, 2008 and September 26, 2008, it overhedged on foreign currency, but had not disclosed. And the fact is, after close of market on September 25th, it announced a loss of half a billion US dollars due to overhedging. And the next day, the trade price of the security dropped by 38%. So we have talked about this in the context of futures and forward. What exactly is overhedging? And even if you're doing an event study where foreign exchange rates matter, for instance, if you're doing an event study of a Chinese firm that is also listed on the US equities market, one of the things you should control for is foreign exchange rates as well. So let's go to look at how exactly Cedia's market worked with all this. So first, let's look at the Brazilian real to US dollars, okay? So on January 2nd, 2007, this is saying that you needed 2.1311 Brazilian reals to buy $1 US, all right? And so this is the range of data that we got from that litigation until 11/3, and you can see it changes quite a lot during this period. So if we were to chart it, this is what it would look like. All right, it starts above 2, then it falls below 2. And remember, when this is number of Brazilian reals per US dollar. So when this is going down, it means the US dollar is strengthening, or the flip side, the Brazilian real is weakening. Okay, so please make sure you're completely on board with the idea of what is the numerator and what's the denominator. So you can see it goes down, which is what the US dollar is strengthening, or the Brazilian, sorry, over here you needed above $2, 2 Brazilian reals to purchase $1 US. Over here you need about 1.6 Brazilian reals to purchase $1 US. Okay, so which means to say the US dollar has weakened, or the Brazilian real has strengthened. Over here, what you're seeing, this rise in the chart means you need more Brazilian real to buy $1 US, which is to say the Brazilian real has depreciated or the US dollar has appreciated. So this is the diagram of the Brazilian real per US dollar. Now, this is one thing that we are going to kind of do a segue going from this into market efficiency, is the idea of consistency. So for different dates, we have the ADR price on the New York Stock Exchange. And this data we get by doing a VLOOKUP. Actually, let me quickly point out to you. So these are the Brazilian real. These are various exchange rates. As you can see, Mavis, one is just the reciprocal of the other. Yeah. So as long as you use, you're careful what you're using, you'll never go wrong. But you have to know which one you're using. Okay. These are the prices of the Cedia's different securities. Remember, its preferred shares are traded on the Bovespa. These are the Cedia ADRs being traded on the US dollar. This is Cedia preferred shares trading on the Bovespa. So these are all the raw data. So this consistency calculations, first of all, we look at the ADR price in US dollars, which we do a VLOOKUP from the relevant data set. This again is also, column C is purely reported data from the data sets that we have taken. Now, why am I specifying all this? Because this came to me from a litigation that I was involved in. A lot of these prices are often not available in the public domain. In the CEDIA case, there is access. I have access to much more data than I would if I were not involved in the litigation. But I'm just kind of, this is a way for you to kind of get your hands dirty with some things. So this is the preferred share in Brazilian real. Number of preferred shares per ADR is 3. That is to say, each ADR, each CEDIA ADR that is trading on the New York Stock Exchange is worth 3 preferred shares of CEDIA that are trading on the Bovespa. Is that clear? That can easily change. But as we can see in our data, it is actually 3 throughout the time period that we're discussing. Any questions?
So would this be like a comparison of the exchange market in New York with the exchange market in the domestic exchanging market?
Exactly. That is exactly the point. That is exactly the point. Thanks, Sheng. Very good.
Thanks.
All right. So this here is the exchange rate, Brazilian real per US dollar. Okay. So now we say over here, we take C2, which is the share price in Sheng in the Brazilian stock market in the Bovespa, multiplied by D2. Remember, this is for each preferred share of CEDIA in the Brazilian market times 3. That gives you the price of 3 preferred shares of CEDIA in Brazilian real. To convert it back to US dollar, you have to divide it by the E column. So this here is the derived price of ADR based on the price in the Brazilian stock market and the exchange rate between Brazilian real and US dollar. This here is the derived price. What is the actual price of the ADR? Okay, is everybody clear why this is equivalent? This is the actual ADR price in the US dollar on the New York Stock Exchange. Simultaneously, it is also trading on the Brazilian Stock Exchange, on the Bovespa. It is Brazilian real, $7.35 Brazilian real, times 3 of those gives you the price of 3 preferred shares. Now remember, the ADR price, each ADR in the US is equivalent to 3 preferred shares of CEDIA. The actual, each preferred share is selling for this amount in the Bovespa. 3 of those is now equivalent to each ADR in the US, but that's in Brazilian real. To convert it into US dollar, you have to divide it by column E. So column F is the price that is derived from the price of each ADR in US dollars derived from the traded price in Bovespa times the number of preferred shares in each ADR adjusted for the exchange rate. Okay, so this is the column B and column F are being compared in real time. So this is on the same day that we are seeing these prices. Now, this is a perfect example of why you should never just stack data sets against each other. For instance, Thanksgiving is a holiday in the US. There is no trading on Thanksgiving. So if you were to stack dates against each other, Thanksgiving for the US, you'll get no data, whereas you will get on that day, there will be data for Bovespa. So you will have dates stacking up, different data matching up to different dates. Okay, so you should never stack data fields against each other. If there is one thing that you've learned from this course, I'm happy for that to be it, that you can never stack data fields against each other. All right. So in principle, one of the things that we'll see, and we'll spend the rest of today's class on market efficiency, is the idea of one price. So what is the difference between $10.35 in the New York Stock Exchange? Exactly the same equity, same security is being sold for, or is being traded at $10.30 in the Bovespa. So is there scope for riskless arbitrage here? Yes, Mavis, you're nodding your head. Please tell us, if you were an internationally savvy trader, as you are, what would you do?
Buy low and sell high.
Yes, so you would then buy in the Bovespa, exchange the money, and sell in the New York Stock Exchange, and make a profit of 4.3 cents per security. Right? So this is riskless arbitrage that you can do. So the law of one price, which is one of the fundamental ideas of market efficiency, which is why I love doing this just before we do market efficiency, would say that F and B should be equal. Any difference between B and F provides an opportunity for riskless arbitrage. So this absolute differential here, which is the absolute value of the difference between columns B and columns F, provide the arbitrage profits that can be made on that particular day. In perfectly efficient markets, remember, this is a number of things have to be efficient. The New York Stock Exchange has to be perfectly efficient. The Bovespa has to be perfectly efficient. The foreign exchange market has to be perfectly efficient. This whole ecosystem has to be perfectly efficient. In that case, all of these would be equal to 0. Okay, do we see some zeros? Yes, we do. Thank goodness for that. Lots of zeros. What is the maximum differential we see is 86 cents. So on January 14th, the ADR is $18.85. Whereas if you do the trade in the Brazilian market, it's $19.71 US cents. So buy low, sell high. You can buy on the New York Stock Exchange, convert the money into Brazilian reals, and sell it there for $19.71, 86 cents per share of arbitrage profits that you can make if you were to do this case. So the law of one price would say this column G should always be equal to 0, but we find it is not always the case. And that is an example of deviation from perfect efficiency of the entire ecosystem, which we will talk about in the rest of the class. Okay, so actually we're running slightly ahead of schedule, which is great. So 10:45 a.m. I have sent you an email with the teaching evaluations. Please take the next 15 minutes to complete your student evaluations. Then we need 100% response rate. So all of you need to do your teaching evaluations. Please don't think of it as a suggestion. You need to do it. So you have the next 15 minutes to do that. And then let's take our 15-minute break and let's regroup at 11:15 a.m. sharp to continue on market efficiency. To me, it's the most interesting part of this course because my entire research and consulting is, well, not entire, but a large portion of that is on market efficiency and deviations from it. All right, so let's regroup at 11:15.